My next presenter is Joseph Cusick. He is from Tradespoon. Now, Joseph currently serves as the Vice President of Wealth and Asset Management for MoneyBlock, where he is responsible for managing the development of the firm's wealth and asset management platform. Now, prior to MoneyBlock, Joseph was a market maker at the Chicago Board of Options Exchange until 2001. He moved off the floor that year and joined the management team of Options Express, where he utilized his CBOE experience to help build and grow the OX's retail and full-service brokerage. And over the next 12 years, Joseph quickly grew his role from a registered representative to the Senior Vice President of Education, where he was directly responsible for the development of Options Express's education and media programs, as well as an integral member of the platform development team. He is a frequent contributor to media outlets such as Wall Street Journal, Business Week, Barron's, CNBC, BNN, and Bloomberg, and passionately delivering common sense solutions to complex issues. Joseph is a graduate of Marquette University and holds a Series 4, 7, and 63 licenses. Now, on that note, I welcome you, Joseph Cusick from Tradespoon. Joseph, can you hear me?
I'm really excited about being on today and talking on behalf of Tradespoon and Trading Block and Money Block. My name is Joe Cusick. Thank you. I'm humbled by the intro, and I am definitely going to cut that down big time going forward. Today I want to talk about an approach. I know I have it set up as options expiration, but this is actually an approach that you can use at any point in time as far as managing positions, whether it's rolling, closing, taking a profit, or taking a loss. These are going to be invaluable opportunities for you to go in and learn more about this. And for those of you that are new, this is not going to be over your head. I know that you've had a ton of great opportunities to listen to some great speakers. I was listening to Dan and the previous speaker, a lot of technical analysis, a lot of rules-based trading, just getting some great insights, and I want to keep that rolling. Before I get started, I would be remiss for saying thank you to Vlad and Tradespoon for having me come talk on their behalf. Vlad is the Tradespoon founder and is an employee of AOS. I do have to go through these real quick, folks, which does business as Trading Block and Money Block, a registered broker-dealer, FINRA, NFA, SIPC member, and a registered investment advisor. Tradespoon and AOS are not affiliated companies, and the content contained in Tradespoon is not endorsed by AOS. AOS has advertising and marketing arrangements with parties that are not registered or regulated as broker-dealers, such as Tradespoon, and as part of these have arrangements where AOS may pay fees or provide other forms of compensation in exchange for marketing. Options do involve risk and may not be suitable for all investors. Read the characteristics and risks of standardized options. Go to the Options Clearing Corp website, or you can go to our website, MoneyBlock or TradingBlock.com. Finally, any stock option or future symbol I'm going to talk about today are for educational and illustrative purposes only, and should not be intended to portray a recommendation to buy, sell, or hold any particular security or underlying. Thanks, folks, and I really appreciate you sitting through that. Now, we do have a limited amount of time, and I do want to jump into this because whether you trade options or stocks, you're going to have some sort of framework on how you're going to have to manage risk. I've heard a lot of different speakers talk about defining risk, whether it's when you're using options with spreads or you're using technical analysis. There's certain other components when you're looking at trading underlyings. Maybe it's very frequently. It could be minutes, days, hours, days, things of that nature. But at this juncture, what I want to do is I'm going to give you some insight that's not going to use technical analysis. It's going to use more of option pricing, and it's also going to start to instill also some logic chain behind the rules. And so I'm going to, first of all, just talk very quickly about the two different styles of exercise for those of you that are new. And please don't abandon ship for those of you that are not new and have been through this. It's only a slide or two. And then we're going to look at four specific strategies, three. We're going to look at single leg options, a long call, long put, and we're also going to look at a short vertical spread. So any of you that do credit spreads, actually I did hear one of the speakers talking about how he does credit spreads. We're going to talk about how to manage that potentially. We're going to assess the profit targets and loss targets. We're going to also look at a plan to roll or close if these targets are either getting close, and we'll talk about how to actually approach that. And the biggest part is got to understand the expiration cycle with options. It's very important. And what I mean is that not only that, 30 days, 10 days, 5 days, but it's understanding what happens to an option price and how that time frame really helps you in your assessments. And then we'll open it up for hopefully a quick Q&A. Another thing that I'm also going to do is I'm going to bring on Vlad when we get an opportunity to talk more about TradeSpoon and the offering. Folks, if you are not familiar with TradeSpoon, wait for Vlad to jump on. He's going to give you a quick synopsis, and it's a great opportunity for you to learn more about that. There's two types of exercise, American and European. I'm going to keep this very simple. American options is every single stock option that you know out there. These are options that can be exercised by long option holders at any point in time before that third Friday or that expiration date. For trading weeklies, that Friday where it expires after being alive for 1 week. European options. Option holders can only exercise their European options on 1 day during that expiration cycle. That's that expiration day, that last trading day. So be aware that if you're trading stock options, if you're buying them, you can exercise your rights at any point in time. If you sell them, you could be assigned at any point in time. So there is innate risks with buying and selling options that you have to understand. With European options, you only have the right to exercise that option at that expiration date. And you're only at risk of being assigned after that expiration date. So the long and short of it is that if you don't want to have early assignment risk, you could trade European options. European options are those cash-settled index. You heard some of the speakers talking about the S&P 500 or the SPX or the NASDAQ, the NDX. These are cash-settled indices that are also European settlement. And again, what is expiration? That's that last day in which an options contract will trade. So once it's expired, it trades no more, then it will settle, and then basically, dependent upon the strategy, you're either going to be profitable or not. And you will have some decisions as you get close to that date. You're either going to be long or short an option. So if you're short an option, you may have an obligation. If you're long an option, you have a right. You have to decide whether or not if you're long an option, you want to exercise those rights, or if you're short an option, are you willing to take on the obligation? Either way, right, you have to make a decision. And what we're going to look at today is what are your options as you get closer to that point in time. So let's take a look at a call setup, a long call setup. And I'm going to look at Public Services Enterprises. It's ticker symbol PEG. I looked at this on June 2nd. And so this was going into July expiration. So this just actually passed. PEG at the time was trading at 38.96. You see the 52-week range, and you see the volatility change. This is the IV rank, as I call it. You're hearing that term a lot more within certain circles. And that's the way a lot of us that have been trading options for I'm going on decades now. It's scary to be able to say that. But basically this number right here is saying that the current implied volatility is 20% higher than its 52-week low. All right. Anytime that you see an IV rank that starts to get north above 50%, that means that there's a real heightened sense of potential violent moves within the options marketplace. In other words, the options marketplace is anticipating the potential underlying, the stock in this case, moving violently. 20%, I'm not so concerned. Whatever the trend is right now and the motion in the market, I'm not too concerned. So we're going to look to buy one of the July $35 calls, and we're going to be willing to pay $4 for that. That $4, if I can say that it's a debit, that means that that's my risk of the trade. All right. Now the first thing that I do is before I click that button to trade, I'm not looking at the charts. You know, if anything, I've already done that, and really I just look at the charts, and this is just me talking. I'm looking at it to see what's gone on in the past. I'm just looking at it to get a really solid idea of what the current trend, what the trend has been in the past. But there's nothing forward-looking in those charts. It's just showing you what's gone on. The expectation of what potentially could happen, well, the only place that I know where that's built into is in the options price. And so for some of you that have gone through my webinars, I like to look at what the option marketplace is pricing in for potential movement, and I can do that over specific periods of time. And then in this case, I'm just pricing out 1 day, 7 day, and 30 days. You're seeing a very straightforward calculation. Some of you might have this built in on your trading platform. Here at Trading Block and Money Block, we're actually building this into the platform as we speak. But a quick way of doing this is taking the current price of the stock, the current implied volatility. This is an average as of the date that I was looking at IB, and that's on the 6/2. I multiply the price times the volatility and divide it by the square root of time. Now, any of you want to understand what the square root of time, it's basically, in this case, there's 252 trading days. I'm not getting into the whole leap year discussion or whatever, but the square root of 252 is 15.87. So I divide this by that, and that gives me what the options marketplace is pricing in as a potential one standard deviation move. Now, do understand that these numbers are dynamic. In other words, when the stock price changes or implied volatility changes, so will the estimated moves. But folks, I can tell you right now, having this understanding of what the options marketplace is pricing in for potential movement under these time frames, there is no real guesswork. It doesn't mean that it has to stay within this range, but at least it gives you something more than just trying to bet on an anticipation. This is giving you a hard number. And again, when I'm looking at price, right, and this is the most transparent piece, this is where the stock was trading at the time that I put this particular trade on, right? So at the time, Public Services was trading at 38 and some change. I buy those options at $4. This is the one thing that I want to point out, right? If I buy these at $4 and I have a profit target of, let's say, 50%, I would put in an order to sell it at $6, or roughly right around there. As a matter of fact, when I believe this was right at the end of June. So this was June 2nd. This was at probably at the end of June, probably on the 29th or so. This is where the stock got at a high. If I plug in that the price range, you'll see that with the stock basically about $2.5 higher, or roughly around there, the option was trading with a theoretical value of around 580. I could have potentially taken a profit at this level, and I would have had a resting order out there. One other nugget that I throw out there for people as far as position maintenance when you're in position initiation is I never have more than 1 to 5%, 1.5 to 5% of the total portfolio ever at risk in any one position. So that's why when I say that I'm doing debit strategies, I don't look at them, to say, oh my gosh, I'm down $2, I have to get out of this, because I know that the $4 I paid for that one contract, that $400 of risk that I have built into this particular strategy, that is less than 5% or less than 3% or less than 1%, whatever your risk tolerance is of my total portfolio. Now, the one thing that I always have to look at, and I'm going to look at the long call within 10 days, because this is where I have to start to make some assessments, whether I'm long or short. And one assessment that I make right away, especially when I'm trading naked options, whether I'm long or short, is I want to know how much premium, that extrinsic premium is left, that time and volatility premium. How much is left in the option that I'm currently trading? Now, one quick way that you can do it is that you can take the stock price, they take the premium of whatever, in this case, the long call is trading, add it to that strike price, and if it is less than or equal to the stock price, then that's telling you that there's very little, if no premium, left in that call option. In other words, you're trading an option that's trading just like stock. Another quick check, if you don't want to do math, folks, is if you look at the same strike put. So in this case, I'm long the $35 calls. I'm going to look at the same strike put, the 35 puts, and I can see that they're no bid at 15 cents. That means that with a no bid at 15 or a no bid at 10 or a no bid at 5 cents, that's telling me there's basically very little, if any, time premium left. For option holders, in other words, people that are long options, which we are in this case, that basically means I'm trading stock, that there is no more time premium left. For option sellers, if you sold this option, and we'll get into this in a minute, with the other example that we're going to walk through. But option sellers, those of you that are trading American-style options, you could be at risk of being assigned even before expiration, okay? And we also refer to these options when they have very little premium as parity options. They're trading equal to where the market's trading. So if that's the case, and as a matter of fact, with PEG, what we decided to do was we decided to say, you know what, we still have our bias on the stock. I don't want to exercise to own the stock outright. I want to still just use that limited risk that's built into just the premium I'm paying for the $35 calls, and I'm willing to roll it to the next month. In other words, from July to August, okay? Now, when you roll, one rule of thumb is that you should be rolling for even money or a small credit. Now, when you're doing long bullish strategies, it's going to be hard-pressed to do it for a credit, right? But you could do it for a small debit or even money. So in this case, we were looking to roll, in other words, sell out the July $35 call, and we're going to buy the August $35 call. That's going to give us another 30 or so days to be in the position. And I want to do that, in this case, for a debit of 5 cents. I'm willing to pay a nickel, or $5 per contract. The advantage of this is it allows me to continue to participate with limited risk and have more time to be right. In other words, if the stock would go from 35 or 37 or 40 to 42, 45, I'm able to participate. The disadvantage is that I'm putting on more risk capital, or continuing to put on this risk capital for another 50 days. So let's say, for example, the stock went up to 40 and some change, which it did do during this expiration cycle, and pulled back to 35. If I didn't take my profits and I'm still in this trade, right, and I can roll this, I'm tying up that risk capital in this position that hasn't worked out yet. Make sure that you've done your assessments so that you say, yeah, you know what, I believe that this trade could still profit. I think that the upside is still the major play, that my bullishness is. And you could use technical analysis. You could use a service that does the technical and fundamental analysis through proprietary scoring or whatnot. But the point being is that you can then roll that trade and continue it. If, in fact, though, you see that you want to get out of the trade and you see an opportunity to get out of a trade at even or better, what I would suggest is just closing the trade. So at this juncture, you see that the stock did go up during the cycle. You didn't take the profits. You see it pull back. You see the option that you're long is trading roughly around where you got into it, roughly around that $4 mark. You can sell the close. Be disciplined enough to keep that capital in your coffers. Even though you were right at one point in time, you didn't have a resting order that got hit. So you have to be disciplined enough, especially if you believe or if you're if in fact your forecast has changed on this particular underlying, you can close it for a break even, or maybe even a slight loss or a slight profit. To me, that's looking like you're a winner, right? Now, let's take a look at it for a put. All right, so we're going to look at Hershey's, HSY. I looked at this on June 10th. The stock was trading at 97.30. You see the 52-week range, and again, you see the IV rank. It's right around 15%, very low. So whatever the current trend of the market was at the time, there wasn't a heightened expectation of potential violent moves. The trend was still in play, and the marketplace was okay with that. I'm looking at buying one of the July, and I'm sorry, I'm doing a put vertical. I'm looking to buy the July 100 puts, but instead of buying those outright, I'm going to sell the July $95 puts, and I'm going to do that for a debit of $2.60. So I'm buying these 100 puts, and if any of you have, if you're looking at this, the 100 strike is above the 97.30 level. These are in the money puts. Now, typically, if you just bought those outright, like what we were doing in the previous example with buying the calls, you'd have to pay $3.45 or 345 bucks. Now, that might be quite a bit of money, right? I mean, really, in reality, you would need the stock to be well below $97. As a matter of fact, you need it to be at 96, right around 96.55 for you to be even break even. Well, I want to mitigate some of that that expense. So I'm selling the 95 puts, and I'm going to collect 85 cents. That means my risk on this trade is $2.60. My profit potential is if the stock goes at or below $95. That's where I stop making any money. So I could make basically $2.40 on a $2.60 risk. Now, what's the marketplace pricing in for potential movement? Well, over the next 30 days, it's pricing in the potential for it to move about $3.75. Now, that is not saying that it's directionally biased. It's not saying that it's going to be down. It's not going to say up. It's basically saying that the underlying has the potential to move $3.75. All right, and always remember this is a dynamic calculation. So with $3.75 being priced in, I have a level of confidence that with the stock trading at 97, it could potentially get down to that 95 level, especially before expiration. I don't expect that it's going to go much below that, so that's why I'm comfortable with selling those 95 puts against it. Now, one thing is that you see my entry price point right here on the chart, which was June 10th. As a matter of fact, I had to live through the market going up. As a matter of fact, it went from 97 and some change to 100. That made me feel good about the fact that I sold the 95 puts, because the 95 puts offset that purchase price of those $100 puts. And that happened. Now, most of you, if you lived through this after buying those conservative deep in the money puts, you would have flipped out, right? And the reason why you would have flipped out is the option that you paid $3.65 may be trading $2.50. But because you sold that put below at 95 and you got into those $100 puts basically at 260, folks, you're not sweating it, right? You're going to reassess. You're going to see, has the trend changed, but you're not sweating it. As you saw, the market pulled back. It actually got down to the level of where your entry was as we got into July cycle, and that's the July expiration cycle of the options. Now, the one thing that you want to do to see if you're at risk, first of all, of being assigned on your short option, right, is you see if there's any time premium. Well, there is none. But you don't really care about that, because if you're assigned on here, you have an offset, and that means you'll also maximize your profit potential. So I want to look at over here, how much time premium is actually left in my long option. That's where I look again at that the opposite calls in this particular situation, and I see they're 14 cents at 24 cents. Folks, that's telling me that there's still plenty of time premium at the time that I was looking at this pricing. So I wouldn't be exercising these if I'm long them, and B, if I were short them, I'm not too overly concerned that I could be potentially assigned. And remember, I'm worried about assignment if I'm short here, only because these are American-style options, these stock options, and you got to keep that in the back of your head. So some of you might say, well, I've traded these before, Joe. The stock went up, it went down, and it's now at a level where if it goes down again and tries to take a next leg to the downside, I could potentially profit from it. The hard part is that I'm within 10 days to expiration. In other words, I might be in the week of expiration, so I may need some more time. What do? You can roll spreads as well. In this case, remember, we set up a long debit spread where I bought the 100 puts and I sold the 95 puts, right? I paid $2.60 for that. What I want to do is say, well, I like these strikes. I like this spread. I believe that the stock will have another leg down, and I believe that it's going to happen in the next 30 to 45 days. What do? I roll from the July, August. You can see I have all four legs built into this, and in this case, I'm going to do it for a nickel. So I'm selling out the the July spread, and I'm going to buy the August spread, and I'm willing to pay for it. You're rolling the position, and you could do this with multi-leg. And the bottom line is that you're rolling right, and you didn't add significant capital risk. In other words, if you can do these or a dime, maybe even 15 cents, but I wouldn't go much above that. Then it's potentially worth doing, especially if you have the convictions on your bias. if in fact stock was up at 100 and you could see that your strike selection doesn't solid, I don't know why you would continue to strategy that you would basically pull up stakes, get off the table what you can, and not tie up the risk capital for another 50 days, especially if biasing gone against you. And the thing that in this case, what we did do is we looked at it and said, while the roll is interesting and we do have the conviction, we go in and we saw that the July $195 put spread, a little bit before expiration, was trading at $2.50. So we got out of the trade. Another reason why we did get out of the trade was just because the action that was to occur, consolidation, we started to get concerned in front of a binary event called earning. This is another example of while we had still 10 days to be right, we had a binary event. We were concerned because we felt that the environment had changed on that, in other words, expiration, where it could have worked against us. Now let's take a look at a short spread. And specifically, we're just going to look at a short. And this is where we're going to look at a vertical on WIN, ticker symbol W. This on June 4th. Stock was trading at roughly around 10 cents. I'm sorry, folks. I want to make sure that I'm not having any issues. I think everybody should see everything okay. Perfect. So the stock was trading at 208.73. You see the 52-week range. Here you see that the IV rank is at 25%. That's telling me that while there's a heightened sense of potential violent moves, it's not past that 50% mark. Again, I'm not thinking that whatever the current trend of the stock, there's not expectation of big violent short-term moves. So I'm looking at the July 205-200 put spread where I'm selling the 205s and I'm going to buy the 200 puts. And I'm going to do that for $1.90 credit. Now that's not the risk on this trade. The risk on the trade is the difference between the strike prices minus this premium received. So right now you have roughly around $3.10 of risk in this trade. In other words, if the stock were to go down to or below $200, that's what your risk is. And that's also the capital that I will be willing to put at risk. And that capital that I'm putting at risk, that $3.10 or 310 bucks, again, does not constitute more than 1.5 to 5%. Now, doing my calculation for 1, 7, and 30 days, I'm seeing that the market is pricing in the potential for a big move. With the stock at 208, right, they're saying that there could be a potential for the stock to be moving around 18 bucks. Again, not directionally biased, and that basically gives me a comfort level of about a 1 standard deviation move, all right? So with me selling the 205 puts with the stock at 208, I might reassess my stock selection, my strike selection. This is why this is also a good exercise when you're doing your estimated move calculation. For those of you who are new, just try to consume that this is the ability to use that forward-looking perspective of the option price. In other words, it's giving you some sort of number of what the options marketplace, the marketplace where it's providing this liquidity, where they're seeing and where they're pricing in the expectation of potential movement. Right? This is pretty powerful stuff. So this is where the stock was trading upon entry. This is where it was trading right as we started to get into the July expiration cycle. So you can see that it pulled back, it tested and went through 200, and then it's been bouncing back. Now, again, I am no master technician, but at the end of the day, it looks like a nice little consolidation, but it's a $10 wide consolidation. And to me, that was where I would have probably reassessed before I put the trade on, the strike selection. These strike prices that I'm trading were too close to where the market was trading, especially with the estimated move that I'm seeing of 18 bucks. But the interesting component here is that you can see that the underlying got as low during the cycle, got as low as 190, let's say 193, and then rallied back up and got into that basically that 211 right? That 211, 212 range. If I'm correct and I'm doing my math, you know, and I know that can be, you know, a little bit sketchy, but if we're in that let's say that 193 to 195, and we're at that 213, 212 range, you're right around that $18 mark from, you know, trough to peak. It's pretty incredible how these option marketplace pricing really is that efficient. So another reason why technicals and looking at charts give you a picture, but the option pricing really gives you that evaluation of potential or expected move in the underlying. In other words, that forward-looking feel. So again, looking at the pricing and seeing, okay, if I'm short these 205 puts with 10 days left to expiration, am I at risk of potentially being assigned? That's where my risk is right now, right on these short puts. Well, I look over at the calls real quick and I see that they're 85 bid at 99. Folks, you're not at risk of being assigned if you're short these puts, at least not at this juncture, okay? So I'm not sweating that. And so with that being said, you know, I don't have to sit there and think I have assignment risk. So what do? Again, you look to potentially roll this. If all of a sudden you see that the stock has gone from 195 back up to 212 and now is back at that, you know, 208 range, you might say, well, I'm still sticking with my convictions. I think the next leg could be to the upside. I'm going to roll the trade. Simply put the 4 legs in, and again, in this particular strategy with these short vertical spreads, these credit spreads, if you roll a credit spread, folks, this is an error. It shouldn't say debit. It should say credit. As a matter of fact, I'm going to go in here. This should say credit, okay? Right? You should roll this for even money or a small credit. As a matter of fact, I could roll this for about a 10-cent credit into the next expiration cycle, which is August. I chose to do the same strike prices. Now, some of you might say, you know what? I lived through this. I could get out of this basically unscathed, where I buy this particular spread back for around $1.90. So if I buy that back for $1.90, I can go in and I can, instead of doing the same strike spread in August, I can go out and maybe say, all right, but I simultaneously want to sell the 190, 185 put spread. Now, you may do that for a debit because you're rolling down, but remember, I'm buying the spread that I originally sold for at the same price, so I'm not too concerned about that. Always remember, if you're going to roll any strategy or any position, just make sure that you're willing to tie up that risk capital for anywhere between 50 to 30 days. Also, you've seen that I'm looking at everything within 10 days of expiration. Here's the reason why. The reason why is that, especially if the options are out of the money, if you're doing credit strategies, most of the time premium is going to be out. Then you're just basically talking, you know, vol risk if vol starts to expand or contract. The other thing is that this is when you should be starting to look at your positions bare minimum. I will have this executed within 5 days before expiration. That's just one of my rules of thumb as far as trading. The other thing, with credit spreads, I will tell you this. I also, for profits in credit spreads, for example, I sold this credit spread for $1.90. I would have had a resting order out there at around 95 cents to buy it back. So if this credit spread and at any point in time between now and July expiration was trading at 95 cents, I would have bought it back and taken my profits at that level. It's just historically that is what I've been doing with credit strategies basically from about 2007 on. That's how I've discussed that. For the debit strategies, I've been taking profits, and obviously it depends on the environment, how fast the market's moved. Right? So if I put a position on and the market's gone in my direction in the first day or two, I might take the profits because you don't look a gift horse in the mouth. But typically I'm taking profits in there around the 50 to 75% mark on the risk capital that I have in play. Now again, if you are nervous, you've lived through this big range, your strike selection was wrong, but you live to fight another day because you look at it, you have the opportunity to go in and buy back your spread that you had originally sold, and you could do it for a debit that's right at maybe a little bit more, or you could even buy it potentially at a better price, especially when you get into 10 or specifically at 5 days before expiration. You want to get out of that. With a stock that could move, like in this case, Win was moving, you don't want to mess with fire. All right, I told you that this was going to be a little bit fast and furious, but you know, again, I think with these little pieces of information that you have at your fingertips, as you get closer to an expiration cycle or you have a big move, you can start thinking about the different applications that you could use as far as, you know, why you're taking profits, why you're cutting losses, or why, or how can I go in and continue a strategy and do it so that it's done as a package, in other words, rolling. If you ever have any questions, you can reach to me directly at either one of these email addresses. And by the way, I am an advisor. I am an investment advisor, so if anyone is interested in sitting down and talking to me about how I construct portfolios and I manage portfolios for individuals, please come talk to me directly at support@moneyblock.com. If you're interested too at looking at a new home, I heard in some of the previous discussions about some of the strategies that brokerage firms might not allow, like trading options in your IRA. Well, we do that. So I want to give an opportunity for all of you to look at Trading Block. And I know I'm running up on time. Do I have 1 more minute? I want to bring on Vlad Karpel with 5 minutes. I want Vlad to talk a little bit more about TradeSpoon and the opportunity you have here.
Hi, Joe. Thanks a lot. Yeah, thanks a lot for a great presentation. I do want to, give you a quick overview of TradeSpoon and what we do. And let's see, TradeSpoon. Yeah, so basically what we're doing at TradeSpoon, we're trying to find what are the best stocks to trade, what are the best sectors that are trending up, and what are the best stocks in each of a given sector. And the way we do this, we basically have a proprietary software that runs every day and finds what are the best stocks in each of the given sector, and what are the in the next 50 days, which of these stocks will be higher than the current market conditions. And you can see here we have two basically scales. One is the long-term rating. This is a combination of fundamental and technical analysis where we assign a score. Score of 10 means we're very bullish on these stocks, and in the next year they will be higher than they are now. And we also assign a short-term trend, which is the probability of where the stock is going to be, that the stock is going to be higher in the next 50 days, this time horizon 50 days. And if you see some of these stocks like TRN, this is the recommendation that we went on June 9th. We told all of the subscribers to TradeSpoon that on June 9th buy TRN, and you can see since June 9 that the stock has been an uptrend, and we provide you with a stock recommendation with specific entry and exit prices. We also provide you with option and option spread recommendations with specific entry and exit prices. So, this is the world of probabilities. We look at the return on capital versus the risk you're taking. The higher the risk, the higher the return on capital. The smaller the risk, the smaller the return on capital. And those are the two numbers that we identify in our trading ahead of time, and we're looking for anywhere from 40 to 60% return on capital per given trade. So for everybody who's on today's webinar, we have a special promotion, and I think you're going to see it in the chat window soon. If you wanted a watch list for specific stocks, if you're looking at the timing, we will provide you with one recommendation a day or one recommendation of the week in a week. And we've been averaging anywhere from 20 to 30% return on each across all the winners and losers, and we're utilizing both stock and option strategies. And everybody who attended this webinar, we're giving a special where for 14 days you can take us on a $1 trial, and after that the regular price is $299 a quarter, and it's over 34% return, over 34% discount on our services. So again, if you're trading, you need to have some kind of a system that ranks the best stocks in each of the given sector. You always want to trade the best stocks, and you always want to find the optimal entry and a setup price. So it is important to make sure that whether it's a TradeSpoon or any other system, you're consistently picking the best stocks in the sector, and you look at the probabilities of where the stock is going to be in the next, whether it's 40 or 50-day horizon, using options data and take advantage of some of the strategies that Joe has covered and we have covered. And again, I want to thank everybody to participating on the webinar, and I'm going to head back to Joe.
Hey guys, and if you have any questions, you can always get back to Vlad at info@tradespoon.com. I think they've been a great partner of ours here at Trading Block and Money Block, and we also appreciate the opportunity with William and team for allowing us to come in and just talk more about what we do and how we approach it. And we do have a lot of different training videos and webinars that we also do in conjunction with each other. So please take an opportunity to take a look at that and our offerings that we have here at both Trading Block and Money Block. So if there isn't any questions, William, I guess I'll toss it back to you. And I want to thank all of you guys for taking time out of your afternoon. It is the close of business, so I'm going to have to go back and see what this market actually has been doing while we've been on the webinar. But I really appreciate the opportunity and look forward to talking to more of you in the future. So take care and thanks a lot.
Great. Thank you, Joseph Cusick, for that wonderful presentation. Once again, that was Joseph Cusick from Trade.